the different mechanisms which are available within the corporate governance system of checks and balances and incentives, or rather aligning incentives among the different stakeholders such as your shareholders, creditors, the board they appoint, the management that they appoint, and other stakeholders like employees, customers, government. So we've got these 6 different type of mechanisms, starting with shareholders, moving on to creditors, then your board of directors, management, employees, customers, suppliers, and government. Let's now first focus on the shareholder mechanisms. Now within your shareholders, of course, the first thing you need is financial reporting mechanism, right? Because until the shareholders don't know what's going on, how are they going to voice their opinion? And then they need a platform where they can voice their opinion, which is the meetings, and certain strategies to get tough with the existing management and the existing board if they don't listen. You could even go to the extent of going to court, and in the extreme scenarios you could force to change the management by going for a corporate takeover. So the first one, of course, is your financial reporting, which is your annual reports. And then there is some non-financial information that could be there coming in from other channels as well, such as your open media. Now this reduces the extent of information asymmetry. Shareholders find out what's going on, which is the performance of the company, which directors and managers are doing a good job, which ones are not, and then they can decide whether they want to buy more shares or sell their shares, or how to vote on key corporate matters such as the sales of a business unit, or maybe some mergers and acquisitions that might be on the table, right? So unless they don't know what's going on, how are they going to vote? And what is the platform? So that's the second thing over here, which is the shareholder meetings. Your normal one is your AGM, your annual general meeting, in which the performance is discussed and normal questions of the shareholders are answered. You could have extraordinary general meetings, can be called any time of the year, where certain sale of a certain business or some merger acquisition transaction is on the table, or maybe you want to change certain company bylaws. And the thing about those type of major decisions or material decisions is that a super majority vote is required, which is greater than 75%. Otherwise, if you've got just some simple decisions coming in, that will be more than 50 or 51%. Now we're moving in the direction of investor activism, but we're still in the shareholder meeting section. Now what does proxy voting mean? So let's say you have some minority shareholders and they are not able to get their way with the current management or board of directors because they don't have majority voting. But what these guys could do is, some of them might be very busy and unable to attend the meetings, so they could give their proxies to the one which is more active, and then this one could then focus all their voting power and try to get some of the management members to agree to do what is best for the shareholders. And another interesting concept is cumulative voting. So let's say there is 3 board seats up for votes this year, right? So each of the shareholders will get 3 votes. Instead of sort of diluting their votes in all 3 seats, what they could do is they could focus all 3 votes on one of these seats. So they try to get at least one person on the board which is going to be their representative. So that is the concept of cumulative voting. And then, of course, you are entering into the world of shareholder activism, that if the management is not listening, the board of directors is not, you're unable to change the board of directors, you're unable to get somebody to represent your opinion, or maybe you're just unable to get through to the current controlling shareholder, then all the other small shareholders could come together and they could use these strategies. One of them was the one that I was saying, in terms of they could get into a sort of a proxy fight where they could get lots of small shareholders to give their proxy to them. And look into somebody called Carl Icahn, very famous shareholder activist, very, very successful. And of course, their focus is to increase shareholder value not only for themselves but also for the people giving them their proxies. And if things get really ugly, then it could possibly go into a lawsuit by one or more of the shareholders, and this lawsuit can be brought against the existing board of directors or the existing management and or the controlling shareholders of the company. Is it possible in all countries? No. So in quite a few countries, the law actually prohibits shareholders from suing or taking legal action against their own management or their own board of directors or their own other shareholders. And the extreme situation is a corporate takeover where, let's say, the company is not listening, the management is not listening. And I think a very, very interesting example here is Xerox versus HP, where HP even did a tender offer to buy out Xerox's shares from its shareholders. It even went to try to do a hostile takeover, right? By bypassing the current HP management, it went directly to HP's shareholders, where one company, which is Xerox in this example, went directly to HP's shareholders because the management wasn't agreeing to sell the company to Xerox. And of course, the simplest version is something which we have already discussed, which is your proxy contest, that you try to get all the small shareholders to vote for you. Now moving on to the second stakeholder group, which is your creditors, the other provider of capital, the provider of debt, and we're going to look at the mechanisms that are there to mitigate their risks. The first one is, of course, the contract that is there between the company and the providers of debt, which is your bond indenture, especially if it is a bond, of course. And this name, indenture, is a special name for this contract, which is signed between the bond issuer and the bond investor. Then, of course, you have your financial reporting, because as you saw in the case of your shareholders, the information asymmetry problem is there. Similarly, for your bondholders or your creditors, the financial reporting is important as well, because they also suffer from information asymmetry. And then finally, we'll talk about creditor committees, which of course only happens when the bankruptcy issue is there. And let us discuss that when we get to that segment. But first, let's focus on the bond indenture, which is nothing but a contract. It's just a special name for a contract, for this specific type of contract that is between the company which is issuing this bond and the bondholders which are buying this bond. And this contract details out the obligations of the company or the issuer and the rights of the investors or the bondholders. The clauses of this contract also have a special name called covenants. You have two types of covenants: affirmative, also known as positive covenants, and restrictive, also known as negative covenants. Now, affirmative covenants make the company do certain things, such as pay your interest on time, right? So that is something that the company has to do, or maintain adequate levels of insurance, right? Negative covenants or restrictive covenants is something that the company cannot do, such as don't pay large dividends, right? Because they don't want that cash to go to the shareholders, they want it to be left in the company to pay interest on time, right? Or don't let your liquidity level fall to below a certain minimum coverage. So this is the contract that is going to protect the bondholders. Now, another thing which protects the bondholders is something called collaterals, where you can have some real estate property or some non-real estate, maybe some other financial guarantee, some cash that they might have set aside to protect the bondholders from the company defaulting. So how will the bondholders know that what is the situation inside the company? Of course, the financial information has to be there in your corporate reporting. So this is similar to what we talked about in the shareholders, that they also need corporate reporting and transparency, and so do the bondholders. And then finally, the third point for your bondholders, which is your credit committees. And this is only in the case where the company files for bankruptcy, in which the company says, hey, I'm sorry, I don't have enough money left to pay your interest on time. So I'm going to liquidate my business, I'm going to sell my assets, and I'm going to use that money to pay back your principal. And to make sure that the bondholders are represented in these bankruptcy proceedings, there will be certain committees formed, and those committees will protect the interest of the bondholder in any type of restructuring or liquidation. Restructuring means maybe some other company will buy them out, or liquidation means their assets will be sold and that money will be used to pay back the creditors. Right, now let's move on to the third stakeholder group here, which is your board of directors and your management. Now here there's some committees that are formed. So what happens is you have your board of directors, but then for each different area of expertise, they don't meet all the time. They will break into subcommittees. So let's say there will be an audit committee which will focus on financial reporting, just to make sure that the financial reporting is done properly. There will be, let's say, a remuneration committee that will focus on compensation, HR related matters, right? So this is a list of the committees where I just gave you an example of the remuneration or compensation committee and audit committee, which is responsible for the financial reporting quality, right? And then you've got your governance committee, nomination committee, risk committee, and investment committee, and we will discuss all of these one by one. So audit committee, reporting, responsible for monitoring the financial reporting process, and that is done through supervising the internal audit function. What is their plan for the annual audit, how it is done, the review, and not just internal but also your external audit, that who is going to be the external auditor, so appointing them, interacting with them, and making sure that the remediation is done properly. Then the governance committee, this is of course linked to the corporate governance, making sure that all types of corporate governance compliance and remediation is in place and the organizational structure is aligned with corporate governance principles. Remuneration will of course be related to the compensation of your executives, making sure there is alignment between executive compensation and your shareholder interests, and going over and reviewing your HR policies. Nomination is who gets to become a director. So the nomination committee goes over that process, that okay, who can become a director. So the board election, identifying senior leadership candidates, which will be your executive directors, making sure there are a certain number of independent directors in the board, right? So they can maintain the board composition in terms of both independence and also in terms of relevant skill sets. You want people with marketing expertise, you want people with financial expertise, you want people with HR expertise, and so on and so forth. Then you've got your risk committee, very, very important. The role of risk management has been growing over the past few years because we've had so many case studies in which there have been failure of risk management. There have been failures of risk management. So this is becoming more and more important. And we need to basically align what is the company's risk profile with that of its appetite. So who are the shareholders? What is the risk appetite that they're having? And is it aligned with the type of risk that the company is taking? And then of course this has to be done at an enterprise level, because you have such large companies now that are in so many different businesses, and it is possible that one business might be diversifying away the risk of the other business unit. So this has to be looked at an enterprise level. Next is my personal favorite, and maybe yours as well, since you are becoming a CFA charter holder, or studying to be a CFA charter holder, is your investment committee. And here we look at different investments. What are the major investment opportunities, assessing them and evaluating the board investment recommendations. Okay, moving on to the fourth stakeholder group here, which is your employees. And there are two mechanisms here. One is your labor laws, and the other is your employment contracts. Labor laws, of course, protect people in terms of how many hours you can make them work, what type of pension they should have, retirement plans, vacation, and leave. All of this is defined in the labor law of that respective country. You can even form unions in many countries to collectively influence the management on issues that they face. And then, of course, you have your contracts, which will define what are the employees' rights and responsibilities, what should be their remuneration, and any other benefits, such as employee stock option plans. Moving to the fifth stakeholder group, customers and suppliers combined together. This, of course, is having only one type of mechanism, which is the contract that you have with the company as a customer or as a supplier. And naturally, it is that contract that defines what will be the course of action in case either party violates the contract. And lastly, you've got your government mechanisms. Here we look at regulations and corporate governance codes. Regulations are, of course, there to protect not only the government's interest but more importantly the consumers. And then very, very careful monitoring is done in certain sensitive industries such as food, healthcare, and financial system. And then, of course, you have your corporate governance codes. And I wish that we have global corporate governance code, where we still don't have them, and I've discussed this earlier, but we are trying to move in that direction. And it would be very nice if we can converge into one global corporate governance code. We still don't have that, but in different countries we are now slowly maturing towards having these corporate governance code, which are being adopted by many regulatory authorities. And one of the main things I believe is that the amount of independence in your board, so independent directors in the board, and specifically I believe the chairman of your audit committee should be an independent director, because you must be getting to feel the importance of the financial statements, because information asymmetry is a core problem which results in the principal agent issue. If you can diffuse that information asymmetry, and how will you do that? By having transparent financial statements, right? And how can you have financial transparent statements? Financial statements, you need to make sure your audit committee is doing a good job by through your internal audit and external audit functions. And therefore, it's very important that the audit committee is independent. They are not influenced by any of the one stakeholder groups, such as your management or your shareholders. It should be independent as much as possible. And ideally, the chairman of that committee should be independent. Anyways, we're going to stop this video now. And in the next one, we'll talk about what are the risks if you don't have good corporate governance, right? So what are the risks of poor corporate governance, and of course what are the benefits of effective corporate governance? So see you in the next one.